I think the market would crash. I think everybody would be very poor.
The closing numbers on the markets today. At one point, the market fell.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
There's a very good chance that there will be a stock market crash of historic proportions before the end of Trump's first term. That's because the Federal Reserve current rate hiking cycle, which started in 2015, is set to pop the everything bubble. To start, the Fed encourages malinvestment by suppressing interest rates lower than their natural levels. This leads companies to invest in plants, equipment, and other capital assets that only appear profitable because borrowing money is extremely cheap. Almost every Fed rate hiking cycle in its creation has ended in a crisis. Sometimes it starts abroad, but it always filters back to the U.S. markets. Specifically, 16 of the last 19 times the Fed started a series of interest rate hikes, some sort of crisis that tanked the stock market followed. That's about 84% of the time, which are pretty good numbers. A few examples of the Fed interest rate fluctuations that led to crashes were in 1929, 1987, 2000, and 2008. Throughout the 1920s, the Federal Reserve easy money policies helped create an enormous stock market bubble. In August 1929, the Fed raised interest rates and effectively ended the easy credit. Only a few months later, the bubble burst on Black Tuesday. The Dow lost over 12% that day. It signaled the beginning of what we all consider to be the Great Depression. In February 1987, the Fed decided to tighten by withdrawing liquidity from the market. This pushed interest rates up. They continued to tighten until Black Monday crash in October of that same year, when the S&P 500 lost 33% of its value. At that point, the Fed quickly reversed its course and started easing again. Next, we had the tech bubble between 1995 and 2000. Greenspan's next rate hike cycle helped to puncture the tech bubble, which was also inflated with easy money. After the tech bubble burst, the S&P 500 was cut in half. The end of the tech bubble caused an economic downturn. Alan Greenspan's Fed responded by dramatically lowering interest rates again. This new easy money ended up flowing into the housing market. Then in 2004, the Fed embarked on another rate hiking cycle. The higher interest rates made it impossible for many Americans to service their mortgage debts. This resulted in the subprime meltdown in the 2008 financial crisis. So here we are today, the everything bubble. It looks like everything is all set for another crisis. As you probably know, the Fed responded to the 2008 financial crisis with unprecedented amounts of easy money as well. Think of the trillions of dollars in money printing programs euphemistically called quantitative easing, and there were 3 rounds of that. At the same time, the Fed effectively took interest rates to zero, the lowest they've been in the entire history of the United States of America. Allegedly, the Fed did this all to save the economy. In other words, the Fed's response to the last crisis sowed the seeds for what I believe will be even a bigger crisis that's coming. Like all prior Fed intervention, the Fed will pop this bubble as well. Since December 2015, the Fed has been steadily raising rates roughly a quarter percentage point per quarter. I think the current rate hike cycle is going to pop the everything bubble. And if you look all around the world, there's starting to be signs that show that the pop is imminent. One of the warning signs, of course, is emerging markets that are flashing red. Earlier this year, the Turkish lira lost over 40% of its value. The Argentine peso tanked a similar amount. These currency crises could foreshadow a coming crisis in the U.S., much in the same way the Asian financial crisis, debt default in the late 1990s. The second warning sign, unsustainable economic expansion. Trillions of dollars in easy money have fueled the second largest economic expansion in U.S. history as measured by GDP. In other words, by historical standards, the current economic expansion will likely end before the next presidential election. The third warning sign, the longest stock bull market yet. Earlier this year, the U.S. stock market broke the all-time record for the longest bull market in history. The market has been rising for nearly a decade straight without a 20% correction. The U.S. economy and stock market are overdue for a recession and correction by any historical standard, regardless of what the Fed actually does. But when you add in the Fed's current rate hiking cycle, the same catalyst for all the prior issues we face, the likelihood of a stock market crash of historic proportions before the end of Trump's first term is very likely. However, the next stock market crash will be a lot worse, and people won't be able to forget, because this next market downturn may last over a decade.